You're watching Business Incorporated live on Channels Television. Coming up, Fitch Solutions expects Ghana's public debt continued uptick to cover large deficits. And Egypt's current account deficit widened in the January to March quarter amid a surge in portfolio outflows. Plus, stock futures flat as all eyes steady on U.S. July jobs report. Hello and welcome to the program. I'm Ladi Williams. First off, let's take a look at how your money is performing at intraday, starting in Africa. It's the last trading day for the week. Let's see what's happening with the NGX. There's marginally up today, about 0.04%, and hoping we see a green close for that market today, while the GSE index is looking much better, up over 0.5%. In North Africa, the EGX 30 closed in the green yesterday, while with quite a big move, about 5%, talking about the EGX 30 there, while Kenya wasn't left out with a green close, was up almost 1%. Moving on now to other markets, Middle East. With markets we track there are in the green. Talking about the UAE there, we see Dubai and Abu Dhabi index up 0.56% and 0.02% respectively. In other regions, we see the Saudi Arabia and Qatari index closed positive in the green. We saw a flat close for the Saudi Arabia index, while the Qatari index closed down about 0.07%. Now, let's head on to Europe, where we see the global race to make chips is heating up. Talking about semiconductor chip with tensions between the U.S. and China over top manufacturer. And let's talk about Taiwan with a favor pitch there. Europe's trying to play catch-up in that sector. We have joining us there Ben from Berlin. Join us to tell us more. Ben, bring us up to speed with what's happening with the chip production in Europe.
There are so many variables at the moment when it comes to global supply chains, and especially global chip makers. And certainly a lot of factors that are hanging in the air right now. You can't rely on Russian energy right now. This could also become a problem with Taiwan's chip-making abilities and abilities to export their chips. At the moment, what China is doing, its military exercises, could amount to a blockade of the Taiwanese island and cause problems. At the same time, Taiwan needs rare earths from China to go into those chips, and China itself needs those chips to put into their electronics that they manufacture and sell to the world. As far as relying on Russian gas, though, goes, you can go to other countries. It's a slow process, of course, weaning yourself off energy from one country, but you cannot simply replace Taiwanese chips right now. Taiwan supplies over 90% of high-end chips to the world. TSMC, its biggest producer, supplies 60% of the chips to the United States. And if those American companies are denied access, it would put back the American consumer electronics and defense industries back by 5 years, according to some analysts. TSMC is also the main supplier of advanced chips to China's tech giant Huawei. And without these chips, Huawei couldn't compete with the likes of Apple and Samsung when it comes to smartphones, or network equipment makers like Cisco, for example. There are definitely supplier jitters at the moment, and it comes at a time that demand for chips is surging. The global economic recovery is continuing from the pandemic, and we've seen a surge in demand, and supply simply hasn't kept up with all of the bottlenecks that were created during this pandemic, and a lot of bottlenecks that were created especially in China.
Right, Ben, is the race for chips at this point with geopolitics. But tell me, what is Europe doing at this point?
Well, it's also a question of what, or more of a question of what is the US doing in Europe, because the American giant Intel is expected to invest a $5 billion amount in advanced semiconductor packaging and assembly plants in Italy. It's part of an $88 billion investment that the US chipmaker announced back in March to up its capacities here in Europe and reduce its reliance on Asian chips and ease the supply crunch at the moment. It's being aided by billions in subsidies by both the EU and the US. The European Commission President Ursula von der Leyen wants the EU to double its share of global chip production from 10% to 20% by 2030. Now, Intel's European investment plans also include a 17 billion euro semiconductor mega site in Magdeburg. That's here in eastern Germany and could spark a tech revival in the region. 2 huge factories, 3,000 high-tech jobs. But it won't come online until 2027, according to the documents I've seen. The German economy minister, Robert Habeck, says that it would boost Europe's digital sovereignty. And we're also seeing financial support coming from the German government for this project. The problem is that these types of factories, or foundries as they're known, are the most expensive factories on Earth, and they take at least 3 years to build. TSMC is also building a $12 billion foundry in Arizona in the United States to make some of its most advanced chips, but production there probably won't start until 2024. So there is definitely a lag here that is also concerning suppliers and also customers. The German chipmaker Infineon is rigorously investing and expanding manufacturing capacities worldwide, but said that these shortages that are being experienced by the industry may last until 2023 for chips outsourced to foundries.
Yeah.
The tight supply conditions in China do contrast, though, with the supply outlook of global automakers. For example, VW reckons expects this chip shortage to ease in the second half of this year. It's also dependent on Taiwan and the situation there, whether or not things escalate, whether or not there is an invasion or war breaks out, or who knows, there could be a repeat of the 1999 earthquake that crippled the tech industry there and crippled the industry worldwide and saw memory chip prices surge.
Right, so much to look out for there right now. All eyes on China and Taiwan. But how are the markets looking?
Well, European stocks sagged at the opening of trading. Traders are continuing to track those Chinese military drills around Taiwan very closely. There are worries that the Chinese maneuvers could hit the shipping lanes, the important shipping lanes and flights that go in and out of Taiwan. Taiwan not just being a global chip maker, but also being a global trader in so many other goods. Asian equities mostly rose on Friday. The oil price is back around pre-Ukraine war levels, so there's a hope of a slowdown in inflation and inflationary pressures. Crude did edge up today, but the expectations of an economic contraction, which is dampening demand, sent oil tumbling over 10% this week. So the talk is that inflation is likely to peak soon.
Right, that was Ben right there in Berlin. Thank you so much, Ben, with all the details about what's happening with chip shortages in Berlin and Europe. Now, let's head on to London. We have Juliana standing by right there. Great to have you, Juliana. So it's all about recession fears right now in the UK, and the BOE has come out to say, you know what, a recession is coming. How are you seeing it?
Well, it's as you said, the Bank of England created a very sombre mood in the UK from yesterday afternoon after rising interest rates by 0.5%, which was to be expected. Interest rates in the UK are now at a 27-year high of 1.75%, and they are going to get higher. And off the back of the announcement, there was a very long, sombre news conference, and Andrew Bailey was pretty clear with his terms, and that is that the UK is heading into a very deep, difficult recession for 5 consecutive quarters, starting at the end of this year, and millions of households across the country are going to be facing the steepest decline in living standards on record. And that is a really hard pill to swallow, especially because we know that things are rising extramentally at the moment. Inflation is currently at 9.4%. They forecast that it is going to rise to 13%. Some independent economists are expecting it to go even higher than that before the end of the year. A lot of this is down to oil and gas prices, which have trebled over the past 12 months. In April, or before April, people were paying on average about £1,100 a year for their energy bills. By October, people are going to be paying £3,000 a year. This is a lot of money, and it is causing quite a concern for millions of people, not just those on the lowest pay. It's also affecting people who are working. It's affecting middle classes too. And I think a lot of people are asking, where is the government response? That was trending on social media last night. And where is the government response? It hasn't really been found anywhere because Parliament is in recess at the moment. Many of the senior ministers are on holiday somewhere. Prime Minister Boris Johnson is slowly coming away from public view. So it's all left to the two Conservative candidates, Liz Truss, the Foreign Secretary, and Rishi Sunak, the former Chancellor of the Exchequer. So it is going to be a very, very difficult time for whoever does become the next Conservative Party leader and the de facto UK Prime Minister on the 5th of September, because it's bad now, and unfortunately it's going to get much worse, and we're not expecting to see a light at the end of the tunnel until at least 2024.
Right. I guess the year of the squeeze didn't disappoint at all this year. But I got another report showing that UK hiring actually slowed. Also, how's that being digested over there?
Well, yeah, this is an interesting report which was published by KPMG alongside the Recruitment and Employment Confederation. And really, it just kind of highlights just how kind of fractured the UK labour market is at the moment. Unemployment is still historically low. I believe it's about 3.2 to 3.3%. So in international standards, that's great, right? A lot of people are in work. The only thing is, a lot of these statistics can sometimes be quite distorting, because if you have a more forensic look at the UK's employment data, you can see that a lot of people who are in employment are on zero contract hours. And according to some charities in the Roundtree Foundation, 70% of individuals who are living in poverty are working. So people are working 2 or 3 jobs here in the UK, but it's just still not enough to cope with travel and food and costs. So yes, and one of the reasons why this is having a knock-on impact on the labour market in terms of the cost of living crisis is because things are just so much more expensive. And once supplies go up, a lot of recruiters are worried about employing more people, even though they need them, because we still have a record 1.25 million vacancies out there. But because there are a lack of skills, people who are going for employment are demanding more wages, not only because they're skilled, but because wages are not stretching as much as they used to. So these are some of the issues that were highlighted in this report today. And again, it's reflecting the kind of serious nature of an economic crisis that Britain is currently facing.
Exactly, with inflation hammering wages worldwide at this point. But what are you seeing in the markets?
Well, the markets in London, anyway, are waiting for the US non-farm roll data, which I think is out probably about now, just to have a kind of look at how the labour market in the world's largest economy is coping, especially because they are facing many of the issues that we're facing here over the pond. But at intraday, the FTSE All-Share is down 0.14%, the FTSE 100 down 2 at 0.18%, and the FTSE 250, the domestic market, slightly up by 0.02%. In the currencies market, the British pound is currently trading down against the US dollar by 0.19%, down 2 against the euro by 0.07%, but the British pound is trading up against the Japanese yen by 0.12% at intraday, Laddie.
All right, Juliana, thank you so much. We're watching out for that US job report later. Thank you.
Thanks.
All right, now let's move on to other markets. We see Taiwan shares led gains in Asia-Pacific markets as investors shake off China's military drills following U.S. House Speaker Nancy Pelosi's visit. Taiwan's TAIEX jumped about 2.27% to 15,036 points, with chipmaker TSMC rising 3.2%. The index traded lower this week as U.S.-China tensions increased over Pelosi's trip. Markets appear unfazed by China's drills around Taiwan, though Japan's defense minister, Nobuo Kishi, said Chinese missiles landed in Japan's exclusive economic zone and called the military drills a serious problem, according to other reports. The Nikkei 225 in Japan rose about 0.87% to 28,175 points, while the Topix index gained 0.85% to 1,947 points. MSCI's broadest index of Asia-Pacific shares outside Japan added 0.92%. And stock futures were little changed today as investors wait for the July jobs report, looking for further clues about the Federal Reserve's path of rate hikes and the state of the economy. Futures on the Dow Jones Industrial Average were up about 25 points at about 0.08%, while the S&P 500 and Nasdaq 100 futures fell slightly. Economists expect 258,000 jobs were added in July, down from 372,000 jobs in June, according to Dow Jones unemployment, and is expected to hold steady at 3.6%. The jobs report will be released later. Could be out, and I will check out for updates on that. And oil prices declined slightly as concerns over supply shortages weren't enough to counteract expected declines in fuel demand. Brent crude declined about 26 cents to $93.86 a barrel, while the U.S. West Texas Intermediate crude shed about 36 cents to trade at $88.18 per barrel. Prices have come under pressure this week as the market has fretted over the impact of inflation on economic growth and demand. But signs of tight supply kept the floor under prices. The OPEC Plus producer group agreed this week to raise its oil output goal by about 100,000 barrels per day in September, but this was one of the smallest increases since such quotas were introduced in 1982, according to OPEC data. All right, we'll take a break now. When we come back, more stories from the African continent. Do stay with us. This is Business Incorporated. Welcome back now to our next conversation. We see global stock markets have been quite volatile with headwinds. Still watching markets right now with investors, looking at risk off again at this point. So we're going to check, what the investor pulse is looking like right now. Joining us now is Shino Lubu, economist and investment consultant, joining us right now from Edmonton. Great to have you on the program.
Be here. I'm Ladi. How are you doing today?
I'm good. Great to have you. So I know this has been a tough year, for investors. And now, we've had the war in Ukraine. Now there's talk about the monkey pox, also, in the works at this time. But what are you seeing, for these markets?
Okay, so in the global market, it's been largely bearish, like and no thanks to a couple of headwinds that we've seen in the year, either two. Chief amongst them is the Russia-Ukraine saga that is not going anytime soon, based on what is the projections. Based on probability, we see that the saga might go on. 92% of analysts believe that it's going to be here until December. So the fears are still there. So for me, it's been a mixture of a bit of good news and bad news. For example, Russia and Ukraine.
So I can hear you.
Okay, so can you hear me?
Yeah, I can hear you. Okay, carry on.
Okay. So, for example, Russia and Ukraine at a point, they signed like an agreement. They saying that they will allow food supply again. So because after they signed, in less than a few hours after it was signed, we found out that Russia bombed one of the ports again. So because of that, that is leaving analysts to think that it might not be as we might not be as excited as should be as far as that is concerned. So wheat prices are still up there. So we cannot say it is out of the window just yet. Now on the part of the energy, so even though the turbine that was blown has been restored, we fear that what's going to happen largely is that Russia will intentionally not allow their supply to go up again, just to make sure that the Europe does not have enough energy, especially as we approach the winter months, so that they can force some of these European countries into this ceasefire according to their own terms. So that might be what we're going to be seeing moving forward. But largely, I think that the market feels that the inflation might be peaking anytime soon, and that is why you have seen a bit of rally, if you like, in some of these equities, amongst other things. So I believe that the market has priced in a lot of the things that are happening just yet, because a lot of the central banks before now had indicated that they will be increasing their policy rate by 100% basis point, 75% basis, sorry, 100 basis point, 75 basis point. All of these things are things that some of these central banks have not done in a long while, because we've had easing for a long period of time. So with some of this easing taken back, and then I see that we might be seeing we might be seeing the end of this, and the market is quite optimistic about that. On a final note, I think that we might be heading towards recession largely. The chance of recession is higher than the it not happening. So because of that, we might be seeing reversal in terms of policy rates anytime soon, just to make sure that there's a balance in overall between price stability and growth.
Right. And, since the year began, we've seen, oil and commodities, we've seen those prices surge. And, some traders, who got in there early have enjoyed all of that rally. But some have held through, the equities market decline. Is this the time to sell off, or do you still hold? Do you think the bottom is here?
Okay, thank you for that question. So I think that largely it's not a time to sell, especially for those who have been in the market prior to now. As a matter of fact, what we are telling investors right now is to just, for those who have been in the market, stay the course. Stay the course, especially. So it's a time to have a long-term view of the market. So if you have not been in the market just yet, I say I say congratulations, because the market is, give or take, you are in a better position if you are going to the market right now. But because you cannot time the market, like we always tell investors, time in the market is better than timing the market. So hence, we always recommend DCA, that is dollar cost averaging method, meaning that you have to just put in that and see what. So if you go into DCA, you don't have to know when exactly the market has plateau or when the market is in the trough. So because your investing kind of strategy is averaging. So I would say, do not sell, hold. If you are not in the market yet, maybe you might just want to have a bit of liquidity on the side, because especially because we think that it could be recession somewhere down the road. So, but if you're in the market already, it's not a time to sell, because if you sell, if you're in the market, then you might just be selling it might not be in the money when you're selling right now.
I guess it's time to have the diamond hands, when it comes to these markets. Thank you so much. That was Shina Olubu, economist and investment analyst. Thank you so much for coming on the program.
Thank you so much for having me. I appreciate you.
All right. So now let's take a look at other stories. Now we see Fitch Solutions said that Ghana's public debt will continue to rise to cover large deficits in the coming quarters, forecasting total public debt to rise from about 79% of gross domestic product in 2021 to 83% in 2022. Subsequently, the debt-to-GDP ratio will hit 84.5% in 2023. Fitch, however, concluded that Ghana's public expenditure will fall to 23.8% of GDP from 25.2% in 2022, in line with the government's medium-term fiscal consolidation objectives. And Egypt's current account deficit widened in January to March quarter amid a surge in portfolio outflows triggered by Russia's invasion of Ukraine. Central Bank said in its balance payments figures that was released yesterday, the current account deficit increased to about $5.79 billion from $5.67 billion in January to March a year earlier. The trade deficit widened in part due to higher commodity prices. The figures showed that the net $14.7 billion in portfolio investments left the country in January to March compared to a net inflow of about $5.8 billion a year earlier. And now we see gold. South Africa's Gold Field said it expects its half-year profit to rise about 33%, driven by about higher metal prices, increased production, but flagged the impact of rising inflation on costs. Gold Field expects headline earnings per share, the main profit measure used in South Africa, of between 56 cents to 60 cents for the 6 months to June 30, up from 45 cents a year earlier. Expects gold production of about 1.201 million ounces, up 9% from 1.104 million ounces. And that's it on Business Incorporated. Thank you so much for watching. I'm Ladi Williams. Enjoy the weekend.